today. So the RBA says more rate hikes ahead. Hello again, it's Martin North from Digital Finance Analytics, with the latest post covering finance and prop news with a distinctively Australian flavour. Today, I'm joined by Peter from Mozo. Hi, Peter. How you doing?
Hi, Martin. I'm great. Thanks. Good to see you today.
Oh, Happy New Year and all that sort of stuff. And of course, early February, the Reserve Bank comes out charging another 25 basis points cash rate hike yesterday. No real surprise, but there was, I think, probably a sting in the tail as well, because they're suggesting that rates may go even higher.
Yeah, well, they say things come in threes, but it seems they can also come in nines too when a central bank's involved, as the RBA's added another 25 basis points to interest rates, taking the cash rate now to 3.35. And yeah, they've said that that's not going to be the end of it. People should buckle up because there's plenty more left where that came from. But, it was way back in 2012 when we last had a cash rate this high. So yeah, it'd be interesting to see how high it gets over the next few months.
I think you make an important point. This is a generational change, isn't it? So there are many people who've only ever known mortgage rates come down and down and down and down rather than go up, right? And the rate of increase is the most extreme that I think I've ever experienced, actually.
Yeah, I've found it quite astounding. I've been working in banking and finance for longer than I care to say. But yeah, I have never seen anything like this. And I can only imagine just how hard it's hitting a lot of families out there who have not been through anything like this before, which is probably the vast majority of people.
Well, I have had a lot of people say to me, well, of course, people have got mortgages way old, so it's not really that significant. But actually, if you look carefully, the data suggests a lot of people did take out mortgages over the last 2 or 3 years. Of course, the RBA was saying no rate rises till 2024 at one stage when the mortgage rate was around 2%. And of course, we had this run up in house prices, which was connected to that. So I reckon there's a good proportion of households who actually are now beginning to see the pressures are rising. And what's happening to the mortgage rate so far? So I think at least a couple of banks have said, yeah, we're going to put them up straight away. We can
Yeah.
assume everyone's going to follow suit, right?
Oh, yeah, the vast majority will simply pass on the full 25 basis points, particularly if you're an existing customer and you've stayed with them. You will almost certainly be hit by the full 25. What we are still seeing a lot of banks doing, though, and for other lenders, is discounting rates for new customers. And that's certainly driving a bit of a refinancing frenzy. There's not much action going on with new mortgages, but the banks are pulling out all the stops to try and attract refinances. So, things like discounted rates and fairly sizable cashback offers. It's not unusual to see a bank offering a $5,000 incentive if you refinance to them. So yeah, I think refinancing is where the action is at right now.
Yes, indeed. Well, the statistics from the ABS showed that was the only growth area in the last month or two. But of course, it's interesting that there are some changes in the refinancing landscape. So Ubank's now saying you can refinance for 35 years, which my reaction was no surprise there. But that's a long, long time, right, to extend your mortgage.
Oh, that adds so much to your interest bill. Every year that you're extending your mortgage, it might give you a little more breathing room now, but the total interest you pay just blows out. I think that 30 years is fairly extreme for a mortgage term, but 35, you're just paying the bank interest for most of your working life. I don't think it's a good idea.
Well, of course, we know already that there are more households who are moving into retirement still with a mortgage in tow, right? And it used to be the case you'd pay off your mortgage while you were working, so you moved into retirement mortgage free. But this is just going to exacerbate that problem, that people are going to end up still sitting on debt, moving into retirement. I suppose the theory from the bank is, well, you can always sell the property at that point and downsize and pay off the mortgage. But it's all a bit precarious, it seems to me.
Yeah, it's not a situation I'd feel comfortable committing to. You're looking at things like having to use part of your super payout to cover paying off your mortgage. And, it just means that you're saving all your life. And in the end, the bank's going to get the money. So, again, not a great idea. Not if you want to have a fairly stress-free retirement.
And the other point, of course, is that whilst those refinance deals are available, you need to have a certain amount of equity in your property and a certain degree of income flowing. It
Yeah,
seems to me that there are more people potentially who are actually now not able to refinance because they don't meet the criteria.
yeah, absolutely. As prices of properties are falling, the equity that people have in their homes, even though they've repaid the same amount of their loan, is sinking. And, if you've got, over 80%, as a loan to value ratio, you're going to find it much harder to refinance. And as you say, conditions are getting tighter generally. People are finding it a little harder to find work now. So, yeah, it's just hitting you from both ends, and making refinancing impossible for a group of people.
So I call those mortgage prisoners. And unfortunately, the double whammy of higher interest rates and equity reduction because of prices sliding could put a lot of pressure. But of course, we've got another group under pressure as well, and those are the fixed rate mortgage holders who have not yet experienced the delights of higher rates until now.
Yeah, so those people are the ones that were lucky enough to get hold of some really great low rates during the pandemic, when the Reserve Bank had its term funding facility operating, which was giving really cheap money to the banks for up to 3 years. So there are people who took out particularly sort of 2 and 3 year fixed rate options that are going to find that their repayments are jumping really significantly as they fall off a rate that's probably around 2% or not much more, and now looking at rates more like 5%. So, that's going to be a really difficult adjustment for some people. The RBA talks about how many households have built up savings buffers, and saying they won't be feeling the full brunt of these increases. But the whole point of what the RBA is doing and hiking rates so far so fast is to make households uncomfortable and force them to reduce spending. So I find it really disingenuous, some of the statements that they make, where they're expressing sympathy and saying, oh, it's not that many people. The whole idea is to affect as many people and make things tighter for as many people as possible. So, I just ignore some of what is coming out of the RBA at the moment.
Yeah, well, there's plenty of spin there. But of course, as you say, they are actually wanting to put more burdens on households because they need to slow the economy. And there's a big debate, of course, as to whether that actually is an effective way of dealing with inflation. But we won't go into that economic discussion now. However, I do think it's quite interesting that in his statement released yesterday, he did say, yeah, there were some who actually had buffers, but he also recognised that there were a lot who actually are now under pressure. I think it's pretty much the first time that I've really seen them recognise that this is creating significant pain.
Yeah, it is good to see them starting to front up to their strategy and being a bit honest about it. But yeah, I think they could have done that a little earlier and been a bit clearer about what was coming.
Yeah, RBA clearer. Oh, well, don't go there. Now, let's just talk about deposits because, of course, the other side of the equation here is that as interest rates rise, in theory, deposit rates should follow. But, of course, we know that deposit rates have been, well, very sluggish to rise, and the banks have tended to be rather slow to pass on some of the benefits to savers.
Yeah, look, it's certainly been patchy. Not all banks are passing on the full increases to their deposit customers, but there are plenty of options out there where they are doing that. So, there are some rates that, at call deposit rates are up around 4.5% for the best rates. So we can expect some of those to go to 4.75 in coming weeks. And at that level, they're starting to overtake the best term deposit rates. So the at call products are starting to look like really good options right now. Although you've got to keep in mind that the expectation is that at some point in the next 12 months, the RBA is going to have to wind back some of the cash rate increases, which will also bring some of those at call deposit rates down. So now it's a question of Do I want to have a little less return for a couple of years on a term deposit, but know what I'm getting? Or do I want to take the maximum interest that I can right now and take the risk that I'll miss out on a better rate for a longer period? So, yeah, it's an interesting turning point in the deposit market.
Yeah, it's an interesting trade-off. I have to say that end of last year there was a 4.95% 5-year term deposit that I grabbed because I thought, I think that's a pretty good, whatever's going to happen, that's a pretty good number.
You did great on that one, Martin. I'm, yeah, in awe. You picked it really well.
Well, we do follow it, so we have to try and make the best we can of it. And I guess also just reflecting on the fact the other thing that's going to happen is that people who are in financial pressure quite often then reach for other loans or reach for more credit cards or higher debts on credit cards. But that's all very, very expensive credit, isn't it?
It is, and it's getting more expensive. You know, there are a few small lenders that will increase their credit card rates in line with the RBA cash rate, but they're relatively low rate products anyway. But a lot of the market sits above 17%. So you really need to be sure of what rate you're paying on your credit card. You know, last month we saw one provider, Latitude. It does some store cards primarily, but it shunted its key rate on a couple of products from 23.95 all the way up to 25.9. Now that's a really steep interest rate. And, there are so many better options out there, even within the credit card space. So, yeah, just make sure that you're not on one of those high rate products is really important.
And one of the other observations I see from my surveys is that some of those people who are refinancing, we spoke about earlier, are actually refinancing and drawing equity out as part of the refinance structure to be able to actually pay off some of those other debts. Now, that's sort of smart in one regard because it can actually reduce the interest rates you're paying. But you've got to be careful because if you keep doing that, then you're going to run out of equity.
Yeah, the thing with shifting over to a home loan for, to cover credit card debts or personal loan debts even, it's a great low rate option. But you've got to remember that the bank will often, amortize that over a longer period. So your repayments might be lower, but in the end, the interest that you pay could be quite a lot. So, if you're going to do that kind of restructuring and consolidate debts, it makes a lot of sense, but make sure that you've got a really clear plan for repaying it over as short a period as possible. Otherwise, you may not end up better off.
Yeah, and sometimes you got to look longer term rather than just short term, right? And I know there's always a need. Well, I got to get over the next 3 months, never mind the next 5 to 10 years. But just do the math, you end up paying a lot more interest potentially than you might otherwise. And of course, that helps the bank's profits, doesn't necessarily help households.
No, yeah. The compounding effect that really helps deposits to grow faster works in reverse for a home loan. The longer that you have debt outstanding, the more interest you're going to be paying. So, yeah, it just pays to be really careful with those.
Absolutely. Do your research and make sure you know what we're getting into. And then one other thing just to touch on before we close out, and that is APRA and the 3% buffer. The new head of APRA sort of signaled, I think, a little bit saying, well, we might look at that 3% buffer because, of course, rates are now significantly higher. Interesting conundrum as to whether they should reduce the buffer. That would make new loans a little bit more accessible to some people. But on the other hand, if rates are going to continue to rise, then you still need to keep the buffer. So what's your thoughts on that?
Yeah, look, it seems like APRA's having a bit of a punt on this. And I don't think that's the right way for a regulator to approach the situation. There's no telling what rates are going to have to do over the next, few years or even 5 years. So I don't think that reversing some of the prudential measures that were implemented a couple of years ago is a very good idea. Could end up just creating a problem for the future and see more people getting themselves into debt that they can't afford.
And as this plays out with higher interest rates, more households potentially getting into financial difficulty, do you think there's a risk of broader financial instability being created by that, or do you think it's going to be sufficiently contained?
Look, it's difficult to tell. I think it depends how quickly the Reserve Bank recognises that it needs to reverse direction. They've got a very clear aim at the moment of fighting inflation and driving that down. But if they do go a bit too far for too long, then sure, they could start creating sort of an economic contagion that spreads throughout the Australian economy, and we could see our lovely low 3.5% or unemployment rate jump up pretty quickly.
Well, in fact, the RBA is forecasting higher unemployment over the next year or two, and they're also saying that inflation won't come back into band until 2025. So you can assume that this architecture of higher rates is going to be there for longer. And that's an important message, I think, for people. So there are still people hoping that magically the RBA is going to turn it off again and we're going to go back to 0.1% or 2% mortgage rates. I think that's really not likely. I think this is going to be a longer cycle of pain. And I think my perspective is that households need to prepare for that. So what are the things they should be doing now, bearing in mind that rates are going to stay high for longer?
Oh, look, the really important thing is to check the interest rate that you're on, make sure it's competitive, see if you can get a better deal. Every bit that you can drive your interest rate down really helps to save money. You don't necessarily have to change lenders to do that. Sometimes it's just, informing yourself, doing your research, and then having a chat with your lender and saying, hey, I could get 0.5% off by switching to this lender. Can you help me out? Can you do something by giving me a better rate? And, it's surprising just how often that pays off. And it's a relatively simple conversation. A few people I've talked to who have done it have just had a chat and the person they're talking to says, yeah, I can do that for you. And the next day they've got a lower rate. So it's not a big deal.
No, there are now specialist retention teams with empowerment to take rates down. So you need to assemble your evidence. So go to Mozo and look at the best out there in the marketplace, and then go and make a phone call or send them an email and say, hey, look, can you match this? Otherwise, I'm thinking of moving. A lot of people find that the banks then say, yeah, sure, no, we want you, right, at the moment. Now, there's no loyalty in Australia right, from the banks, right? They're not going to actually offer you cheap loans until you make a fuss. But the point is, if you do make a fuss and you are going armed, there is a huge opportunity still, I think, to negotiate a better rate. And unfortunately, we have to do the walking because the banks won't.
Yeah, those advertised rates are really just a starting point for lenders. There's always opportunity to argue for a discount. And as long as you're informed, you should be able to get something out of them.
Absolutely. So forearmed is forewarned, and go to the comparison sites and see what the best ones are, and then go from there. Peter, I really appreciate your time today. Very important thoughts, and specifically at this time, which is uncertain for many people. So thank you very much, and we'll pick up the conversation probably when the RBA does the next one.
Yeah, possibly next month.
Probably so. Thank you, Peter. Take care.
Bye.